They won't cut rates in July, but I'm beginning to think that they could cut in September because a few Fed speakers, including Powell at that press conference at his last meeting, did highlight the growing importance of them watching the labor market and the unemployment rate as something factoring into their debate on rates, where for the last couple of years we know it's been all about inflation. And if you start to see, well, 4% unemployment rate we know is historically low, but it just so happens to be a 2.5-year high. So if that all of a sudden starts to creep up ahead of that September meeting, 4.1, 4.2, 4.3, whatever it is, because we're also seeing lessening demand for labor in the continuing claims data, a pickup in firings in the initial claims data, job openings that are shrinking, that if you get a further increase in the unemployment rate here, I think the Fed might try to squeeze one in September.
Hi, welcome to Wealthion. I'm James Conner. Well, here we are at the start of another quarter, and companies will be reporting their Q2 numbers soon in the coming weeks. But we've already seen a few companies warn ahead of their Q2 numbers, and they're all citing the same reason why, and that is a weakening consumer. Is this foretelling of what's to come in the economy? To help answer this question, my guest today is Peter Boockvar, Chief Investment Officer of Bleakly Financial Group and the editor of the Boock Report. Peter, thank you very much for joining us today.
Good to be here. Thanks, James.
Peter, I want to start our conversation on the U.S. economy. The Q1 GDP was revised down from 1.6 to 1.3%. This implies a slowing economy. Walgreens recently announced that they're shutting down over 2,000 stores, and one of the reasons is because of the weakening consumer. And the CEO did state that he continues to see persistent pressures on the U.S. consumer. And we've heard the same sort of scenario coming out of Starbucks and also McDonald's. What are your thoughts on the U.S. economy? And maybe you can also share your thoughts on how you think the U.S. consumer is doing.
Yeah, the comments were widespread amongst all retailers and restaurants and anybody selling consumer products based on all the earnings calls that I've listened to over the past few months. One of the more sort of sad but interesting comments came from a company called Casey General Stores, which owns a bunch of convenience stores in the Midwest. They said the higher income consumer is doing fine when they pump gas or hop into their mini mart and buy stuff. But they gave an example of lower income consumers that are buying more fountain soda instead of buying bottles out of the fridge to save money. I mean, you're talking about saving, what, 50 cents? Maybe. So that tells me just how value conscious and deal seeking a portion of the consumer population is. And it's not just low end, it's middle income. It's those that are making more than 100 grand, 150 grand that are now shopping at Walmart or going to Dollar General because they're looking for bargains. And in fact, Walmart at a Bank of America conference used the same word that I've heard from them, from the CFO there, for 2 to 3 quarters now, and was choiceful. And the consumer being, again, budget conscious and prioritizing their spend on needs more so than wants, on non-discretionary things more so than discretionary things. But all that said, we also had great numbers from Carnival saying that their earnings and their revenue and earnings and bookings and yield are at record highs, and they have pricing power. And business seems to be great because they're catering to both a budget consumer, for those that want to travel lower cost, but also baby boomers and other retirees that are benefiting from a higher stock market, 5% interest income on their savings. So it is a very bifurcated sort of 2-lane consumer highway that we're seeing. And I think that can be said for other parts of the economy too, reflecting overall a very mixed and uneven economic situation right now.
Yeah, there seems to be a big disparity between various companies in the market right now. In Q1, Ticketmaster came out with their numbers. They said they were the strongest numbers in the history of the company. They're expecting record numbers for this year. So people are still going out and they're spending a lot of money on events such as concerts. And but to your point, here people don't even want to spend $5 on a cappuccino at Starbucks or to buy a can of Coke at a convenience store.
So we actually own Live Nation stock, so I follow that industry very closely. And speaking also from personal experience, I was just at the Sphere in Las Vegas seeing Dead & Company, and it was jam-packed, and you would not think that there was any stress on the consumer. And we're talking about prices that are with fees, face value, are up to almost $400 per ticket. And in the secondary market, they were going for almost 2,000. So there was no recession there. There was no consumer strain there. And again, to your point about live entertainment being a positive area of the economy, but also to the experiential point made on Carnival, to where consumers are allocating their spend.
Peter, I haven't been to Las Vegas in a long time, and I haven't gone to this new event space that I keep hearing about. But how was the concert, and how was this fair?
It was phenomenal. Not only do I love the music, the visuals is what really blows you away. And combining the two made it an amazing experience and a sight to be seen. You have to tolerate the heat. It was 108 degrees, but that's Vegas during the summer. But that's when the band is playing there, so you got to adjust. And I highly recommend it.
So yes, I'm going to have to check it out at some point. Now, I made mention earlier the fact that Q1 GDP came in or was revised downwards to 1.3 from 1.6. Where do you think the Q2 number is going to come in at? Is it going to be closer to 1 or even lower?
Looking at the Atlanta Fed, to use that as one sort of measure of an estimate, is down to 2.2. I've been arguing for the last couple months, actually going back into Q1 before we even saw a GDP number, that based on everything that I was hearing from companies and on corporate earnings calls and all the data, that it felt much more like a 1.5% type economy than a 3% economy. And I feel even more confident of that from everything that I've seen in Q2. So I think when all is said and done, when the Q2 GDP number actually gets reported, I think it's more likely to have a one handle than a two handle. Now, that's not a recession, but it's pretty lackluster growth. But with a lot of puts and takes, we talked about the two different types of consumers we're seeing. Look at the housing market, the pace of existing home sales around 30-year lows, but new builds doing better. Manufacturing in a recession, but government spending and government-induced manufacturing facility construction doing well. Infrastructure spending pretty robust. Global trade very mixed. So there's a lot of uncertainty with respect to what we're seeing in visibility in the economy, and also capital spending a layer on. We saw durable goods. Core durable goods orders is essentially flatline for 2 years now. So, like I said, this feels like a one-ish type economy rather than something around 3 or even in the 2s.
And when you talk about core durable goods, what products are you talking about exactly?
It's non-defense capital goods ex aircraft. So it takes out volatile defense spending, takes out aircraft because you can get big orders 1 month and a slowdown the next, and it's just a timing thing. So it's measuring orders for durable goods such as machinery, electrical equipment, autos, metals, stuff like that. That is a good proxy measure for capital spending.
So let's talk about inflation now. The personal consumption expenditure, or PCE, came in at 2.6% for the month of May, in line with expectations, and this is a key indicator for the Fed. But do you think inflation is coming under control, or do you think it might be reigniting again?
So it's mixed. I mean, obviously it's certainly moderating. It's nice to see a two handle. I have a personal issue with PCE relative to CPI because they overweight healthcare in the PCE, but that healthcare calculation is mostly Medicare, Medicaid reimbursement rates, and when the government is price fixing it, it doesn't really give you a good gauge of inflation, as opposed to CPI, where it's mostly measuring out-of-pocket medical costs, like your health insurance, for example. But the Fed's certainly going to be happy with the trajectory of inflation. But what I have, I think we have to understand that seeing an inflation spike and watching it come back down, the downside of it getting to the two-ish level is not winning the war on inflation. It's keeping it down on a sustainable basis. That's what wins the war. And here we are, goods prices have been the main driver of this disinflation. In fact, goods prices year over year, give or take, is averaging about zero, which is where it was pre-COVID. But I'm seeing signs that that's going to inflect higher, particularly in shipping costs. I watch the World Container Index every Thursday, which gives pricing on the container shipping route from Shanghai to other cities like Rotterdam in the Netherlands, LA on the US West Coast, Genoa in Italy. And those prices have skyrocketed. To give an example, the Shanghai to Rotterdam route got as high as almost 15,000 at the peak in probably 2021 into early 2022. Then it fell all the way down to under $2,000. This is on a 40-foot container, which is basically where it was in February 2020. Well, now it's back over 7,000. And that's over, call it 6 months. And just over the past 10 weeks, that index is up 140% on that particular route, up a little less than that if you on the ship trip from Shanghai to LA. So this is already impacting air cargo routes because people who are having issues getting space on a container ship or don't want to pay that are shifting to air, and those prices are jumping. Trucking prices still remain low in the U.S. because still a lot of excess capacity, but we're sort of getting this replay of the COVID situation, and this is definitely going to flow into consumer products at some point, or if it's not, it's going to be eaten in profit margins. And this is just, we're a few months away from starting to ship holiday goods. So you have the potential inflecting higher in goods prices. Now, the flip side, services should continue to decelerate because rental growth is going to slow and show up in PCE and CPI in the back half of this year. But we're sowing the seeds for reacceleration in rental prices because after the flood of construction this year gets completed, there's very little supply coming online thereafter. And I still see very robust demand for renting because of the very unaffordable situation with buying a home.
You made mention of the fact that you prefer CPI, and the three largest components of CPI are shelter, food, and energy. And oil has been up 10% here in the last month or so, trading around $80 a barrel. Are you concerned about the price of oil here and that it might keep going and maybe go to $90 or $100 a barrel?
Well, from an investor standpoint, we're long energy stocks, so I'd like to see 90. From a consumer standpoint and an economic standpoint, it would put a further squeeze on a consumer that can't afford a further squeeze, because it would also imply higher gasoline prices. Now, I do think oil prices go much higher in the next couple of years. I do think we see triple digits again, and possibly well into the triple digits, because of the big picture lack of investment. I mean, I follow weekly rig counts, at least in the U.S. Obviously, the U.S. is only a call it 13% of, or a little less than that, total global oil production on a daily basis. But it's amazing at $80 oil prices that rig counts in the U.S. continue to drop. So U.S. oil production, at least for now, is plateaued. That's not to say that it can't start increasing again. But if $80 is not incentivizing more oil drilling, it tells me that we need higher prices in order to do so.
And the fact that oil is trading around $80 and it's been in a pretty tight range here this year, $70 to $80. Do you think that's an indication that maybe the economy or the global economy is slowing?
So that is one of the questions, is whether there's a demand side issue right now, whether it's less diesel demand for trucks that are taking stuff from point A to point B, or it's the consumer that's not driving as much because they're obviously watching the dollars that they spend. It very well could be. We know China is a big consumer of oil. and that economy has been extraordinarily mixed. So it's something that I'm watching closely, no doubt about it, as a potential negative for the price of oil.
So now that inflation is at least heading toward the Fed's 2% target rate, do you, the Fed had a meeting in June. They left rates unchanged. We have another one coming at the end of the month, I believe on the 31st. Do you think we'll see the Fed cut rates in this month?
They won't cut rates in July, but I'm beginning to think that they could cut in September because a few Fed speakers, including Powell at that press conference at his last meeting, did highlight the growing importance of them watching the labor market and the unemployment rate as something factoring into their debate on rates, where for the last couple of years we know it's been all about inflation. And if you start to see, well, 4% unemployment rate we know is historically low, but it just so happens to be a 2.5 year high. So if that all of a sudden starts to creep up ahead of that September meeting, 4.1, 4.2, 4.3, whatever it is, because we're also seeing lessening demand for labor in the continuing claims data, a pickup in firings in the initial claims data, job openings that are shrinking, that if you get a further increase in the unemployment rate here, I think the Fed might try to squeeze one in September. Now, they'll likely telegraph that at Jackson Hole in August, but I do think September is a growing possibility. Whereas before, some commentary from like Mary Daly, for example, over the last couple of weeks, I was thinking, you know what, they don't want to even bother with the election. They don't even want to be perceived as being political. They're just going to wait till December. I think a 4.2, 4.3 unemployment rate is going to sort of pressure them to cut, but also couching that into some similar to the way the ECB did as a hawkish cut, that letting the markets know that this is not the beginning of a long string of rate cuts. But if it ended up being the beginning of a string of rate cuts, that would be because the economy is really rolling over. So I don't think we want to wish for that.
So I want to get your views on the S&P and the Nasdaq now. And in spite of some of your concerns that you have for the economy and that the economy might be slowing, the consumer's not spending as much. It's like this stock market doesn't care about anything, right? It just keeps going higher. The S&P's up 15% on the year. Nasdaq's up closer to 20% on the year. NVIDIA, I got to bring that one up. It's up 150% on the year. What's your view on the stock market? Do you still like it here? Do you think it's going to keep going higher?
Well, just as there's seemingly like a two-sided economy here, there's also a two-sided stock market. Yeah, the S&P is up 14 plus percent, but the Russell 2000 is down on the year, maybe 1% or even maybe flattish. The equal weight S&P is up maybe 4.5%. So it's a very bifurcated stock market, just as it is a bifurcated economy. So it really depends on what you own will determine whether you're having a good year in the stock market or not. Now, you can always say that that's always the case, but it's seemingly more so now since a select few are driving those major indices. I do think that has to be reconciled at some point, because who are the customers of Microsoft buying software and services? It's small, medium-sized businesses. Who are big customers of Meta and Google buying advertising? It's small, medium-sized businesses. So how can you have those companies doing so well, but many of their customers not doing so well? That is just not a sustainable trend. Now, of course, AI and all the excitement there is what's resulting in some of this discrepancies and divergences, but it does need to be reconciled at some point, and I think sooner rather than later. Either the smaller names are going to catch up to the upside, or the bigger names are going to catch up to the downside. Historically speaking, when you get this divergence, it's usually big that dips down to the small, but we'll see.
Right. And so once again, as we go into the second half of the year, do you think the S&P keeps going?
It's shocked me year to date on how well it's done, but again, it's very isolated in terms of what's driving it, most of the performance. And I think with the valuations in NVIDIA, for example, of $3 trillion, I mean, I went back and looked at what the peak price to sales ratio was, because I prefer to value NVIDIA on a price to sales basis, not price to earnings. People tell me, oh, it's reasonable. It's only 45 times price to earnings. And I said, yes, it's only reasonable at that price if you assume that a 76% profit margin is sustainable for many, many years. And I believe it's not, especially when NVIDIA's, I think, half of their revenue is coming from 4 or 5 customers. And those customers are every day trying to design their own chips that will inevitably compete with NVIDIA. So I would rather value NVIDIA on a price to sales basis. And on its January 25 fiscal year revenue estimate of 120 billion, it's trading at 26 times sales. If you go back to the peak NVIDIA price to sales ratio in 2000, it was priced at 24 times sales. Now, their gross margin then was about 65%, so it was less than NVIDIA, and its PE multiple was much greater. But on a price to sales basis, it's rather similar. And here we are 24 years later, and Cisco's stock is still below where it was. I'm not saying that's NVIDIA. We own stock in it, but I don't sleep well knowing that we do.
I like that comparison to the early 2000s and the late 1990s. Those were crazy times. And talking about AI, I mean, all you have to do is just mention AI and your stock will catch a bid. And when you look at Apple, I think it was flat on the year, and then they came out with this Apple, what do they call it?
Apple Intelligence.
Apple Intelligence. Now the stock's up 15% on the year, so it's kind of interesting. It makes you wonder too if this whole AI thing is overdone.
Well, the spending on it, on developing it, the generative AI, is certainly for real. The return on that spend, though, is highly uncertain. The market needs to see more use cases. Now, from what I've seen so far, there's a lot of impressive stuff that will come of this. But now, in order to really show the benefits in terms of productivity and revenue generators or expense savers, the market's going to need to see that. Because right now, we're really only seeing one side of this AI craze, and that's really the spending side. We need to see the benefits on the consumption side of generative AI and the returns on that consumption.
So, Peter, I want to get your views now. You've expressed a lot of concerns about the economy slowing down and also valuations in the stock market. What are you recommending to clients in terms of asset allocation?
So I'm just going to tell you what some of the stuff that we own, just to put our money where our mouth is. I mentioned owning energy stocks. We've been pretty bullish on commodities for the last couple of years, believing that they're just bombed out relative to the S&P 500. So energy, oil and gas stocks, uranium stocks, precious metals and the physical and the miners, copper stocks, also ag stocks, and also there. I think there are a lot of bunch of value names that we own and like that have been beaten down because of this shift out of them compared to other parts of the market. There are parts of Asia that we're bullish on. We're bullish on Japan. One of our recent Japanese purchases was the company that owns 7-Eleven, 7 and Holdings, trading at a pretty reasonable valuation and one of the dominant convenience store operators in North America and Japan, and going to be rolling out a lot of 7-Elevens in other countries and emerging markets. So an example of one name. And we've been bullish, but it hasn't been the best trade on Asian travel and the growing middle class. So we own some of the casino stocks in Macau. Numbers are rebounding nicely, but the stocks haven't really reflected that yet. So I just think that there are a lot of opportunities out there outside of the most popular names, which, again, have done extraordinarily well, as we know. But I don't think that should prevent people from solely focusing on them because they're very crowded. They're very rich in valuation. And other parts of the market do exist, and we all breathe the same economic air.
So it sounds like you have a big weighting toward commodities. You're long energy, uranium, and copper. What's your thesis there?
So copper, it's certainly a supply-demand story. We know the growing demand for copper is not no longer Chinese construction of apartment buildings. That it has obviously found some new use cases. Precious metals, silver is half the demand for silver is industrial, so there's some overlap there in terms of benefits that copper is deriving from, but also very much bullish on the monetary side of gold and silver, just because of the rising debts and deficits of the U.S., the growing central bank demand for metals, the growing demand in terms of trade outside of the U.S. dollar, like the Chinese buying oil from Saudi in renminbi, buying oil and natural gas from Russia in renminbi, buying corn and soybeans from Brazil and Argentina in renminbi, India buying oil from Saudi Arabia in rupee. To me, that's a very interesting dynamic where less dollars are getting recycled in U.S. Treasuries, and whatever's left over gets bought in the gold market. So to me, that's interesting. Ag has been beaten up, and we had owned like Mosaic and Nutrien, two fertilizer names, going into the Russian invasion, and we sold it on that spike. But both stocks have gotten cut in half since. So we've recently re-entered them. Believing that crop prices are cheap, and there's an opportunity here where you get a good dividend, cheap valuation, and believe that in this kind of environment, it's a pretty good opportunity, because I prefer looking at things through a value lens, and that's what attracts me to names like that.
Well, that's great. That's a great overview, Peter. And as we wrap up, if someone would like to learn more about you and your various services, where can they go?
So on the wealth management side, they can go to our website, bleakly.com, and learn more about our services, and they can reach out. And if they're interested in reading my daily commentary, they can check me out on Substack under my name, and it's the Boock Report. And I write daily on macro and micro economic and market stuff.
Well, once again, thank you, and I look forward to our next discussion.
Thanks, James. Same here.
Well, I hope you enjoyed that discussion with Peter Boockvar, and it provided you with some insights on what to expect in the coming months. If you're trying to figure out how to prepare for your financial future, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with a vetted advisor. There's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and hit that notification button to be kept up to date on upcoming events. Once again, I want to thank you for spending time with us today, and I look forward to seeing you again soon.